Hello and welcome to our AIM Summit webinar on ESG in emerging markets. The session is sponsored by Fitch Ratings. I'm your host, Zachary Seferati, CEO and founder of Dalma Capital and strategic partner of AIM Summit. We have so many audience members joining us today from over 50 countries. Amongst you are institutional investors, family offices, high net worth individuals, and many leaders of the financial services industry. Please feel free, this is going to be an interactive session for those of you who are joining us live. So feel free to submit your questions. There's a Q&A dialogue at the bottom of your screen. Ask them as they come at any time. We're going to be addressing questions after the fireside chat at the end of the session. If you're joining us on YouTube after the fact, please like this video and subscribe to our YouTube channel so you receive all of our AIM Summit webinars. Introducing our partner today for this session is Fitch Ratings. Fitch Ratings is the leading provider of credit ratings, commentary, and research, dedicated to providing you with value beyond the rating through independent and prospective credit opinions. Fitch Ratings offers global perspectives shaped by strong global market experience and credit market expertise. The additional context, perspective, and insights that they provide have helped fund a century of growth and enables you to make important credit judgments with confidence. Introducing our guest speaker today, none other than the legendary Mark Mobius. Dr. Mark Mobius is seen by many as the founder of the emerging markets asset class. He has a reputation as one of the most successful and influential managers over the last 30 years. In May 2018, with two of his ex-colleagues, he launched Mobius Capital Partners. The firm utilizes a highly specialized active investment management approach with an emphasis on improving governance standards in emerging and frontier market companies. Due to this, Dr. Mobius was employed at Franklin Templeton Investments for more than 30 years. Most recently as the executive chairman of Templeton Emerging Markets Group. During his tenure, the group expanded AUM from $100 million to over $40 billion and launched a number of emerging market and frontier funds focused in Asia, Latin America, Africa, and Eastern Europe. His career and his influence has earned him numerous industry awards. He's truly a legend, and it's such a pleasure to have him with us today. Also in our session, as part of this fireside chat, is Mervyn Tang. Mervyn Tang is the Senior Director and Global Head of ESG Research at Fitch Ratings' Sustainable Finance Division. He's based in Hong Kong and oversees a global research team of 5, which primarily focuses on thematic and cross-sector ESG research. Mervyn rejoined Fitch Ratings in March 2019 from MSCI, where he was the head of fixed income in their ESG research department. He's worked with fixed income investors globally, supporting them on integrating ESG into their investment process. He has also worked as an international economist at the Bank of England, a diplomat at the British Embassy in Washington, D.C., and is an equities analyst at Citigroup. It's such a pleasure to have you both today. We're very excited for this fireside chat. Gentlemen, over to you. Without further ado, thank you so much for joining us.
Thank you.
Thank you, Zach. I'm just as excited as you are about this, an opportunity to interview an emerging markets and ESG guru. I mean, Zach mentioned with Mobius Capital's investment strategy is about identifying companies with poor governance in EMs and then getting them to improve. I would love to hear about how you actually do that. So what are the common EM governance issues that materialize, and like what are the low-hanging fruits that you can fix, and what's harder for you as an activist investor to do something about?
Well, first of all, the emphasis that we have in our two funds, we have one fund listed in the UK, Investment Trust, another one in Luxembourg, open-ended fund. And the emphasis, first of all, is to, as you mentioned, improve corporate governance. By that, we mean improving transparency, improving the structure of the board, for example, having independent directors on the board, improving the way you communicate with investors, and a number of other subsidiary ideas that we bring to the table when we invest in these companies. But I must say that it's a very careful selection process that we have. After we're satisfied with the financials and the outlook for a company, we then ask them whether they're willing to engage with us to improve governance. And of course, one of the first things I give them is our book, Invest for Good, which outlines our philosophy. If they say yes, they're interested, then we invest. If they say they're not interested, then we will not invest. So our activist, if you will, approach is more consensual. In other words, we want to engage in a friendly way and gradually improve their governance. Now, I must say, there are many companies that really have no idea what governance is. Many of them, of course, have heard about ESG. They know their environmental, social situations that they have to pay attention to. But generally speaking, they're not too familiar with it. So our job is to educate them and then help them improve the governance, because we feel that once you have a good governance, then you can do something about the social and environmental aspects.
That's interesting when you mention this consensual approach. Do you find the willingness to accept your support in terms of improving governance varying across regions, across sectors, depending on who you speak to?
It's interesting. There's not much difference when you comes to countries or sectors. If the management is open to the idea, then it doesn't make any difference where they're from. In fact, just this morning, we had a conference call with a Taiwanese company, and they're a terrific company, good technology, growing very fast, but they really didn't have a clue about corporate governance, but they were happy to engage with us and said, you know, frankly, we've been so busy with our business, we haven't paid much attention to ESG and particularly on governance. So we told them that we'd be happy to help them improve the governance aspect. And of course, one of the first things for them in this case was to improve investor information. In other words, getting to investors with more information, more transparency.
One of the interesting things that we hear from some emerging market issuers, particularly in, say, APAC, is they are concerned that with the way that ESG analysis is done, that their particular models of governance are viewed negatively versus more Anglo-Saxon independent dispersed shareholder approaches. Do you see, what do you think of that argument? Do you think there's an optimal model of governance, or do you think there's various different types of governance models that can succeed?
That's a very, very good point, particularly as you know, in Asia, the picture is substantially different from other parts of the world when it comes to listed companies, because in Asia, the family company is quite prevalent, particularly in the small and middle-sized companies, which is where we focus on those companies in the small and middle size. And you'll have a company where you know, the father is the chairman, the mother is on the board, the son is on the board, the cousin is on the board, and they think this is great, you know, because they can operate very easily. And we tell them, wait a minute, you know, you're a listed company, you have shareholders from all over the world. It's about time you have some independent directors. But I think you have to make some adjustment for the family companies, because there is value in the family being involved, because they have a stake in the company to improve the company. And if they improve the company, it's going to be good for all shareholders. Nevertheless, it's very important for these family companies to bring in outside advice. And we've been pretty successful in recommending that to a number of companies around the world, where we said, look, you should really bring in some outside directors. By the way, a good example of that is in Turkey, where many years ago we were invested in Turkish Airlines. And at that time, of course, the control was, well, it still is in the hands of the government. And we approached the president as to whether he'd be willing to have some independent directors, because up to that time, all the directors were government related. And we had to fly to Ankara, to the capital, to talk to the minister about it. And the minister was very forthcoming. He said, look, we'd be happy to have you bring in an independent director, even two. And since that time, there's been incredible improvement in the airline. That was many years ago, of course, but that's an example of where even at the government level, where you have government-controlled companies, which, as you know, are very common in China, you can get some independent directors that can add a lot of value to the company.
On that state influence point, yeah, absolutely. You see that in China and actually a lot of emerging markets. From a governance perspective, or as an investor, do you see there's certain structures and certain things you can do that help to make that state ownership or state influence work better from an investment perspective, or do you just approach state-owned companies from a different view?
Well, first of all, you must realize that although you may think negatively about state control of companies, the reality on the ground is that a state-owned company is a pretty good insurance policy, because chances of the company going bankrupt are going to be very low. So that's one positive aspect. The other aspect is that more and more countries, and by the way, particularly in China, are getting interested in ESG and improving their ESG pattern, because it's in the national interest to improve the environmental, social aspects. And in China, interestingly enough, the government has been pushing for governance reform, better corporate governance. Now, why are they doing that? Well, it's a very smart idea, because they know that good governance is going to result in better performance, better profitability for a company. So, and of course, if the government owns 50% or more of the company, better financial performance will be good for the government. So this is the kind of thing that you're seeing more and more of around the world. Governments are waking up to the reality that they've got to have companies that have good ESG practices, and particularly good governance practices. So we look at this favorably. Of course, the kinds of companies that we look at normally are not government controlled, simply because government controlled companies tend to be much larger, and we're focusing on the medium and smaller companies.
So you mentioned that the government, as well as more and more investors, are looking at ESG as well as governance issues. Do you start seeing that reflected in the price and in the way that when you engage with companies, that they are also being influenced or facing engagement from other asset managers? Has it changed? Has basically the boom of ESG just changed the environment for you from your perspective?
Oh yeah, definitely. The emphasis on ESG, all the publicity about ESG has really helped, in the sense that when we walk into a company, at least they know what we're talking about. Generally speaking, they know ESG is something. In fact, last year we were in Brazil, and we walked into one of the companies, and they had a big sign on the wall, sustainability. So then we said, you know what ESG is? And they said, well, I'm not quite sure, but they knew what sustainability was. So there's a greater awareness globally. And by the way, one of the most important factors is, as you know, institutional investors around the world, particularly in the US and Europe, are demanding that companies in which they invest adhere to good ESG practices. And of course, if you look at the numbers, you'll find out that there's a lot of wisdom in that approach, because the numbers show that high ESG rated companies tend to perform better in the stock market. Their stock prices tend to do better. With
this kind of boom in ESG, one bit of feedback we tend to hear from some issuers is that some of the ESG rating and score providers tend to be correlated with, say, the level of development. So if you're in a more developed EM, you have slightly better ESG scores than those in the least developed economies. Do you see that being an issue? Do you think the ESG industry is approaching emerging markets well, or is there a lot of room for improvement still?
I think they're approaching it well, in the sense that they're adhering to the same principles that they apply to the developed market companies. And as you know, they usually have a checklist. They go down the list. In fact, we present that list to many of the companies into which we invest, and they adhere to those principles. But as I mentioned, some of the principles are not quite appropriate for a number of companies. And I mentioned family-owned companies would be one example. There are other industry, how can I say, industry restrictions or problems that you have. For example, let's say you're talking to a company in Korea that does integrated circuit design. This is mainly software work. It's mainly lab work, which does not involve chemicals or anything polluting. So when it comes down to the checklist about what they're doing with the environment, they're not doing anything because there's no impact of what they do on the environment. And the only way they can go to that is go to the factories that do the foundry work for the integrated circuits, which may use a lot of water, a lot of electricity, et cetera, et cetera. So it becomes quite complicated and difficult for them to justify that they're doing anything for the environment. So that's one example where the normal checklist does not work in some companies.
Maybe one more on governance, just so a question that we hear a lot, I think not just in developed markets and EM markets, but how do you deal with the maverick CEO, particularly in tech companies? I think the Teslas of the world come to mind, but I think you see you see evidence of this or examples of this in EMs as well. When you do have the flamboyant, the founder which has started a company from scratch, how do you manage the governance assessment process? Are they much less likely to agree to, say, the influence and support you guys have on governance?
Oh, sure. We have many examples of companies where they don't want to even talk about it because they're successful, they're making a lot of money. Why should they pay any attention to it? And there are many companies who really don't care what their stock price is doing because they're more involved in making money for the company and paying out dividends to themselves and to other shareholders. And in those cases, as I mentioned, we would not get involved because we don't think they're going to be a very good target for us. But there are cases where the founder is interested in improving his share price for a number of reasons. One, of course, they're a big shareholder and they may be thinking of selling some of their shares or using their shares as collateral for bank loans. So in that case, when we come around and say, look, we can help you improve your share price, then they get interested in that sort of effort. But there are many, many companies who really don't care one way or the other and don't want to be bothered because they're so focused on their business.
Maybe now moving on to macro, which I think is such a big part of EM investing and how that ties in with ESG, I guess, particularly in this world where we have a pandemic and mass lockdowns across the world. From your perspective, how do you blend more traditional macro considerations in emerging markets in terms of external finances, geopolitics, trade environment with ESG analysis?
Well, first of all, as you know, when we're looking at investing, we have to look at the macro environment generally. So in the case of the situation we are now facing with lockdowns as a result of COVID-19, we're very concerned about the impact of the lockdowns on the economies. So we are tending to favor those countries that have not been too strict on the lockdowns, simply because the economic activity tends to be shut down, so to speak, or at least substantially modified in the downside. So the lockdowns are probably the key variable that we're looking at in terms of impact of the COVID-19 epidemic. After that, of course, we look at other factors such as the currency, which is very, very important. We look at the general environment in the country, what impact it's having on the health of its citizens. For example, if you look at China and you look at India, they are dependent for over 50% of their power on coal. So obviously that has implications for health, welfare, and so forth. So we have to look at these factors as well. But I would say more importantly at this stage is the severity of the lockdowns.
In terms of the severity of lockdowns, is that do you think just a direct variable you look at, or do you see that in terms of, say, governance indicators or other measures at the sovereign level, that certain economies have handled the lockdown and just the overall situation better? Or has there been not much institutional differences when it comes to governance quality?
Well, you know, at the beginning, when this whole thing hit in February, March, and countries started locking down, everybody was affected. Almost every country in the world followed the leader, so to speak, followed what Europe was doing. They were looking at Italy and they got frightened, and there was sort of a panic. So everybody locked down too severely, I would say. For example, at the time, that was March, April, I was in South Africa, and South Africa locked down much too severely, in my view, because you already had 30% unemployment going into COVID-19. And then, of course, with the lockdown, the unemployment shot up probably to 50, 60%. So that was very, very bad for the economy. And I believe it was a major policy error on the part of the South African government. And a number of other countries did that. So we look at that and say, look, look at those countries that are not so severe in their lockdowns and are using it more rationally. In other words, they're doing it in a more rational way. For example, Germany. In fact, I flew from South Africa to Germany, and you know, in South Africa, I couldn't even walk on the street in Durban. In Germany, I got out of the hotel, hopped on a bike, went down to the river, and it was like Miami Beach. Everybody was sunbathing on the river. I mean, you know, so it was a completely different situation. And you could see that the Germans were handling it much more rationally, so that their economy was not hurt as much. So that's the kind of thing we look at to see if a country is doing things in a rational way.
Apart from, say, direct measures to manage the pandemic through lockdowns or other policies, do you have a view in terms of fiscal and monetary policy in EM? What have you looked for in terms of economies that you would prefer to invest in, or is fiscal and monetary policy not a huge factor in the current environment?
Well, first of all, we really don't avoid any particular country because they're having fiscal difficulties or because their currency is being hammered. What we do pay attention to is the ability of us to get money out of the country and into the country. So foreign exchange controls are very, very important. And in that respect, if they're in fiscal difficulty, particularly at the foreign exchange level, we have to pay attention to that. But there are very few cases where we've said, look, we will not go into this country at all. And the reason for that is that, let's take foreign currency, let's say the exchange rates, which are really the most important factor on the macro arena. And if the currency is getting weaker and looks like it's going to get weaker, that could be very good for some companies in that country. So we have to look at it on a case-by-case basis. After we're satisfied of going into the country in the first place, that the government is not going to lock down the foreign exchange, then we look at the individual company, and let's say a company is exporting a lot and the local costs, of course, are going down in local currency. They're getting foreign currency, but they're going to do very well. So that's the way we look at it. We try to be pragmatic at an individual company level.
In terms of time horizon, and as we, well, fingers crossed, start to move from the current environment to a new state of the world post-COVID, do you think there will be a change in your approach for looking at emerging markets in that new post-COVID world compared to if this pandemic never happened?
Oh, there's been incredible, incredible change. Because just remember that this, I call it the COVID panic, has created a totally different environment when it comes to communication, when it comes to research, and with the need to communicate via the internet or the way we're doing now through video conferencing, the use of this internet system globally has exploded. There's been an incredible impact on many, many industries. Take, for example, the entertainment industry. Attendance in movie theaters is going down, and more people are looking at videos. That's a huge, huge change in one industry as one example. And of course, that's resulted in a big, big change in the way movies are produced. So that would be, just one small example of the impact. If I look at every industry, we have seen the impact of the COVID-19 shutdown and how people have to rely more and more on digitalization. Retailing, as you know, is now becoming more online rather than offline. And you can go down the list of industries and you'll see more and more use is being made of the internet and digital communication. In our business, we're doing research every day. We're using the conference calls, video conferencing, and so forth. But I must say, face-to-face communication is not out. We will have to return to face-to-face communication because there's so much you can learn by observing. Just when you're talking to people, body language is important, and the environment where you're meeting is important. So all these things are going to return, but the basic communication system and the use of the digital era has fundamentally changed the way we do business globally, and that's because of COVID-19.
The acceleration of digitalization point is really interesting because I think just talking to some academics on development, I think one thing they mention is that there's very few examples of emerging market countries who can develop while skipping the industrialization stage. You need to build a national champion, build an industry, and then like Korea, you move into digital businesses. Do you think we are starting to move into a world where a developing country, even a frontier economy, can skip industrialization and move straight into digitalized economy?
It's already happening. In fact, we're seeing more and more of this around the world, particularly in some of the frontier markets in Africa, for example. They're just going right into digitalization. If you look at just the internet revolution that's hit these countries, it's quite remarkable how they picked up the very latest technology. For example, smartphones. There are over 1 billion smartphones sold every year. Can you imagine? If you're going from 3G to 4G to 5G, the power of this vehicle, this handheld vehicle, is incredible and having a big, big impact on these countries. So, for example, as you know, we're invested in one company in Kenya. It's basically a subsidiary of the company in the UK that does communications, and they have done a digital money transfer system using handheld smartphones. In fact, they don't even need smartphones; they can use regular phones. And that's an example where they bypassed the entire banking industry and moved into a completely revolutionary way of transferring money. So this is just one example of where you're getting a leapfrogging effect. And by the way, the impact of this, of course, is a elimination of inflation. Basically, we're in a deflationary world because the use of digital communications is lowering the cost of so many products around the world that it's becoming a situation where prices are actually going down in real terms.
I want to change tack a little bit with the 5 minutes we have left and really just focus on climate change because a huge macro and systemic risk, and also one area which is increasingly under focus. From your investment perspective, how do you handle climate change in your investment process, be it transition risk, physical risk, or looking for climate opportunities?
Of course, we look at that if a company is threatened by climate change in one way or the other. For example, let's say they're producing winter clothes and the weather is getting warmer. They're not going to be very successful unless they change tack. So we do look at that sort of thing. Unfortunately, the measurement of climate change is done in decades, not in minutes, not in days, not in weeks, not in months. So the ability to make a decision as regards to the impact of climate change is not easy. In many cases, even impossible. However, the impact psychologically is there because as more and more people talk about the elimination of fossil fuels, this is having a substantial impact on any oil company, any coal company, any power plant that's burning these fossil fuels. So you've got to take that into consideration. And if you look at our portfolio, you'll notice we have none of these companies in the portfolio because we realize these guys are going to get into trouble sooner or later as this climate change situation changes. On the other hand, there are opportunities. So solar, wind power. In fact, yesterday we were talking to a company that does the cables and harnesses for solar and wind power installations, and they're doing a tremendous business. And their forecast is for even greater growth going forward. So that's an example where climate change is really helping us.
That time horizon question, it's one we get often that brought up in credit ratings, particularly kind of with a very defined time frame. In terms of the measurement of climate risk in time, do you think this is something that you can technologize away? So we'll just be getting improvement technology in the measurement of climate change to be able to make those snap decisions? Or is the problem just so complex that it's just something we have to deal with?
It's a very complex problem. And as you know, you only have to go into YouTube and look up climate change, and you'll find there are many detractors to the idea of climate change. Scientists, a number of scientists have said, look, this is not happening or it's not important because this is a cyclical development that we see in the history of mankind. So I would say that is something we're going to hear more and more about as we go forward. I think there'll be more challenges to the concept of what is climate change, how fast it's moving, and so forth. The other factor we must remember is that although we talk about climate change taking place in decades, all we need is one meteorite to hit the Earth, and you're going to see climate change in spades, which is why I think it's very good that NASA is looking at interfering with some of these asteroids that are headed towards the US, because just one event like that could have an incredible impact. And we've seen that, if you remember the Krakatau explosion in Indonesia, which I think was at the turn of the century, 1900s, beginning of 1900s, it created climate change. That explosion of the Krakatau volcano resulted in big climate change around the world for a number of years, I believe. So this is the kind of thing we have to be aware of as well.
One last question before I pass it back to Zach. So I think with the influx of ESG investors, the focus on climate change, I think there was a question that a few people have posed on, when does climate change start getting priced in? And when do other ESG issues start being priced in or even overpriced in the market? Do you think we're still very far from this stage, or do you think there'll be certain ESG issues or climate change issues that are already quite well factored in?
They're already factored in. The climate change, as I mentioned, is already factored in when it comes to looking at fossil fuel companies. Definitely, it's had an impact on these companies and their stock prices. So we are in that phase right now. And now, regardless of how you look at it, whether you believe in climate change or not, the reality is that, like the COVID panic, people are in a panic about climate change, and their buying decisions will be influenced by their thinking in that regard. So definitely, we're definitely in that era.
That's great. Thank you, Mark. I've learned so much from this conversation. Zach, I'll pass it back to you for Q&A.
Excellent. Thank you so much. It was such a good discussion so far. We have so many questions coming in from the Q&A. Again, and for everyone in the audience, please feel free to submit your questions. We won't be able to get to all of them, but we will share them with Dr. Mobius and with the team at Fitch for after the session. Starting off, I can't help myself but to ask a question on India. We have so many people who've joined us from India. And Mark, I know that you've always been a big fan and an expert on investing in India. We have actually two questions from Chris V, who's asked just your general thoughts on India and the market, given the fact that the market has been quite robust, but the economy remains so weak, and then diving deeper into your strategy and ESG, taking an ESG kind of activist approach in India, whether that works with promoters and family shareholders in India, given that they can be quite hostile towards initiatives that even when they are in the interest of all shareholders.
Very interesting you have that question, because India is now in our portfolio the largest weighting of any country. So we're very, very interested in India and very happy with the performance of the Indian market. Interestingly enough, we're getting quite a lot of interest from the companies in which we invest in India as regards to ESG and governance. The nice thing about India is that executives there speak English. It's easy to communicate. In Taiwan or China, we often have to get a translator, and it's more difficult to communicate, but they're equally helpful and very willing to discuss. But in India, it's much, much easier, and the people there are quite aware about what ESG is, et cetera, et cetera. Now, I'm not saying that all companies will accept this approach and will accept the ability to improve, but the bottom line is that most of the companies are aware of it, and the companies which we deal with have been very open and helpful and willing to work with us to improve governance. So we're on the right track in India, that's for sure.
A question for both of you, and this is actually a personal question from my side. When you're looking across the spectrum at different emerging and frontier markets, you're obviously investing in countries that have different relative levels of industrialization and development. Do you apply the same ESG standards across those different markets, or will you hold countries that are still industrializing or maybe more on the edge of frontier to a lower standard or a lower benchmark than you might hold one of the more developed emerging markets?
Well, we apply the same standard. We don't change the standard at all. We think that emerging market companies can meet the standards, and if they can't, then they've got to work on improving them. So there's no change in the standards that we use. I don't know what Fitch, Revin, whether you act the same way.
We do, and I guess at Fitch, we look at ESG from how it affects the credit profile perspective, as opposed to just trying to make an assessment on how good or bad a country is at ESG. So depending on what factor we're talking about, there's going to be correlations with level of development or not. With something like social indicators, like the number of hospital beds you have, education levels, institutional quality when it comes to what World Bank says, it tends to be highly correlated with the level of development. But then credit ratings is as well. But if we start looking at environmental risks, so your exposure to natural disasters and catastrophe risk, that is not really related to development at all. I mean, there is the vulnerability isn't, the resilience in terms of how well you got your economy can handle it in terms of insurance, in terms of fiscal policy to actually deal with a natural disaster shock is different. So for us, we have to analyze these ESG issues risk by risk and then tie it back to the credit metrics like public debt, GDP growth, GDP volatility. And so it's not very much about saying this economy is doing better in ESG based on a certain peer group or certain rating group.
Interesting. I mean, just diving a little bit deeper on that, if you wouldn't mind, on the environmental standard, the one criticism that I've heard on ESG in frontier and emerging markets is that some of these markets are still pre-industrialized, and if for example, we're starving certain industries of capital that may be crucial for development, industries like steel that may actually, not fall within typically environmentally beneficial criteria, we may be preventing these countries from being able to industrialize the way the developed world has. Mark, would you have any response to people that address that criticism?
Well, there's no question this is a big problem in many countries. In fact, I remember seeing an interview from a leader in Africa who said, look, you guys in the developed countries are depriving us of the ability to grow because you are not funding our coal-fired power plants. We need power, and the cheapest way we can get it is using coal, and you're preventing us from doing that. So this is a big, big issue, and something that the World Bank, the IFC, and the other multilateral institutions are facing. How do they allow these companies to develop without jeopardizing the ESG factors? So yes, I would say it's something that it's a big challenge. Let's put it that way.
Thank you. So actually discussing these ESG factors, so many of them are highly qualitative in nature. One of the questions from Petteri Soinen is, how do you set measurable KPIs for environmental and social improvements in your portfolio companies? And what kind of timeline do you apply for measure and engagement performance against them?
Well, first of all, in terms of timeline, we use one moment in time. When I say one moment, what I really mean is 1 day or 1 week in time. In other words, we'll say, look, let's take a snapshot of the ESG factors. We get the checklist, check down the list. Where does this company now stand in terms of this checklist? In terms of the problem is that the checklists are binary. It's yes or no. Are they meeting or not? It's not a situation where you're scaling. Of course, some of the measures can be scaled, but more or less it's yes or no. So in that sense, a lot of things are missed. There's no question about that. You tend to miss a lot of the shades of meaning of change that's taking place with the company. But that's the way it's currently done. And unfortunately, it's not a perfect system yet. And if you compare the different measures, ESG measures by a number of organizations, quite a few organizations are doing this. There are many differences, big differences from one to the other.
Mervyn, if you wouldn't mind, highlighting exploring the same from the Fitch perspective.
It's an interesting one because when we talk about what our analysts do, you have a set of quantitative indicators, but to translate that into some meaningful understanding of the company, that requires the qualitative analysis, right? So I think one example that people often give on the smartphones front is if you have something like an Apple where most of the production is outsourced elsewhere, your scope 1 and scope 2 looks much lower per phone compared to, say, a Samsung, where you are producing much of that in-house. And so if you just have a portfolio which you are tilting based on scope 1 and scope 2, you're not actually doing anything. Like iPhone and Samsung Galaxy has pretty much probably the same supply chain carbon emissions overall. So it's about trying to convert that quantitative indicator into some analytical judgment. And so for us, it's quite often, say, regulation and other policies or social behavior, consumer behavior that Mark mentioned earlier, that we have to translate that carbon emissions number into. So let's take something like Europe, where you've seen a lot of carbon pricing and emission regulations. One thing that we found is in the early stages, when let's say in 2008, when the last decade, basically, when the emission trading system started to be introduced, actually for a lot of utilities, they were able to pass through that higher carbon price through wholesale electricity prices. So the actual credit impact from the carbon policy is limited if you look at the history. Of course, now that we're talking about potentially much tighter climate regulations and a much larger increase in carbon pricing, that ability to adjust your business model is going to be very different. But I think the lesson that we learned from that is you just can't take one company and another company and go, this one has a higher carbon emissions, and therefore it's more exposed to climate change risks. You need to do a much more in-depth analysis than that.
Of course. So actually, Mark, here's an exciting question from Julia Madden. She's actually asking for a specific example or maybe multiple examples that you could give where taking an ESG approach helped you get a higher return or avoid a loss in one of your investments in companies.
Yeah, I can give you an example of a company engaged in garment manufacturing that this happened a number of years ago. This was in China, and they obviously, had environmental problems in the use of water and so forth and so on. But one of the things we found out that this company was very diligent in recycling the water that they were using in their garment manufacturing process, because they were doing dyeing and all that, which is quite polluting if you allowed this water to go into the river or into the ground without being purified. So there's an example of a company that did a terrific job in recycling the water they were using, which is the main pollutant they were talking about. The other thing that they did at the social level was to give workers face masks. By the way, this is before COVID-19, but the reason why is that, when you manufacture these garments and using textiles, there's a lot of dust in the air, and people can have real lung problems if this is, inhaled for a long period of time. So there's another example where at the social level, they were doing a good job in making sure the workers were not getting ill as a result of breathing in the dust particles. So when we went into this company, we noticed these factors because we were aware that these were environmental and social problems that they had to face, and they were doing a good job in really implementing policies that would help alleviate this situation. So we have a number of examples like that around the world where we've noticed that companies have adopted policies which were very good from a social and environmental point of view. But by the way, you must remember that the ESG idea is not really new. The term is new, but since we started investing in 1987, we always looked at these factors because we realized that a company that had sick workers was not going to be a very good company. A company that polluted the river was probably going to get in trouble with the community in any case. So we had to pay attention to these factors.
So are there actually Taking that further, you gave us an example where you picked a good company and it performed well. Are there any companies that you've looked at? I'm sure there must be many where they did not pass your ESG criteria, and then you followed that company years later, and as a result of their policies, they actually suffered some kind of loss. Are there any landmines that you've avoided where those ESG criteria have prevented you from otherwise investing in what could have been a company that might have actually resulted in a loss?
How many hours do we have? I could give you so many examples of companies that we did not avoid. Probably the most prominent example is in Brazil, Petrobras. Now, there's an example where, we were invested in that company. We did all the research we could, but we couldn't dig into what was happening at the financial level in terms of money that was being paid out to various parties. And as you know, the scandal that took place, the so-called Lava Jato scandal in Brazil. Lava Jato means car wash, because money was being laundered through a car wash company, small car wash company in Rio. There's an example where we really missed it. We didn't recognize what was happening, even though you had audited accounts, blah blah blah, all the rest of it, and it blew up into a major scandal. And now the company is doing a terrific job in corporate governance. They're very, very cautious and careful, but that's after millions and millions of dollars of losses for shareholders.
There's this misconception amongst a lot of companies that because applying high standards in ESG might be costly, that will have a negative impact on the company's financial performance. But from an investor's standpoint, actually investors investing in companies with strong ESG ratings and criteria have actually outperformed, and in some cases significantly outperformed the market, even adjusting for risk. Do you mind unpackaging that? Why ESG companies with strong ESG ratings tend to outperform, and what degree of outperformance you've observed that these companies tend to generate?
We have a chart which shows the performance of high-rated ESG companies and companies that are not rated, and the difference is quite remarkable. It's something like over a 5-year period, about 20% difference. So it's a big difference between high rating ESG and companies that have low rating or no rating at all. So that's one thing. And of course, that has to do with the companies that rate these companies. Part of it is because if a company has a high rating, investors are more likely, particularly big institutional investors, are more likely to invest in that company. But what is not measured is the impact of the improvement in the performance, the financial performance of these companies. And of course, we can find many examples of where companies who adopted various standards, healthy environmental standards, actually improve their financial performance. If you pay attention to, for example, worker safety, worker care, the morale of the workers is higher and productivity goes up. That's just one example. And there are many other examples like that. So for example, paying attention to waste removal is very important, because it often will save companies in material costs by watching what kind of waste they're producing. So there are many examples like that where the actual performance financially is improved.
A question from Sylvia Solomon, focusing on the S in ESG. And I've always found this to be in the acronym, people tend to understand the E and they tend to understand the G, but they always find the S a little bit harder to understand and quantify. Her specific question is, how do you differentiate between cultural factors in emerging markets when focusing on the S in ESG? And do you mind kind of unpackaging what the S in ESG actually means from an investor's perspective?
A very interesting point on culture. If you travel around the world, you'll find that every culture has its own standards of behavior, of course, but generally speaking, people around the world understand what proper behavior towards their fellow man and woman is. And usually the standards are very high at the personal level. If you ask people on the street what they think about, behavior towards their fellow people in the community, they will have very high standards. They will want to perform very well. The problem comes is when you get at a company level where profitability is the only objective. They tend to then begin to ignore some of the social behavior that they would have at a personal level. And that's where we like to bring that to the attention of a company. And we ask the company management, look, would you behave this way towards your family and your friends? And the answer is probably not. So this is where we then begin to make headway. We begin to say, now look, your workers are now working 10 hours a day. They're overworked, they're tired. Why not cut down the number of hours? You'll see better productivity and your health of your workers will be better going forward. Your worker turnover will be less. So that's the kind of thing we look at. Now, a lot of people think of the social aspect at the company level is something to do with the community. It is in some respects insofar as you don't want to have a negative impact on the community, but more often than not, it has to do with the company itself, how they're behaving towards people in the company. Of course, there are examples where the company will do well if they pay attention to community health and welfare and education. For example, there's one company that we know in Bangladesh. They set up a factory in a remote region where they had to have workers come in. And what they did is they said, look, we're going to build a school, we're going to build a health clinic, because these people coming in need this, and it will be good for us as well, because they'll be able to stay near work and they won't have to travel so far, they won't be so tired. So that's an example where the behavior of the company is directly connected to the company itself.
This is probably a question we could also spend another few hours on. So, and we're at the very end of our webinar. I can't believe an hour went by so quickly, but it's been such an interesting session. But a question from Matthew Hodgkinson. He also is focusing on emerging markets, specifically in Africa. And he said that currency generally is one of their key risks, if not the largest risk to their USD returns. From your career, do you have any guidance you can give on how to forecast and address devaluation risks in your portfolio when investing in emerging markets and frontier markets?
Yes, we look at the devaluation risk in a number of ways, and Mervyn would probably do a better job in explaining this for me because Fitch is at the top of in terms of looking at these kinds of risks. But what we do is we look at, first of all, how much foreign exchange do they have? Because if they don't have foreign exchange in their central bank, we're going to be in trouble in getting money out of the country. That's number one. Number two, what is the trade balance? In other words, are they building up a positive trade balance and thereby bringing in foreign exchange? And by the way, we look at not only the physical trade, but invisible trade. In other words, the invisible is often more important than that. The other thing is the policy of the government. What is the government policy regarding balance of payments and also government debt? So we have to look at government debt as another factor. So these are all the factors that we will look at when assessing whether a currency is going to get substantially weaker or not. By the way, one of the things we learned during the Asian financial crisis is that companies that try to fix or influence the exchange rate normally get into big trouble. So we like to see companies that have a free and open foreign exchange market so that the true level of the currency can be ascertained. As you know, during the financial crisis, Thailand wanted to hold the Thai baht to, I think it was about 20 baht to $1, and they spent all their foreign exchange defending the Thai baht. And then when they didn't have foreign exchange, the Thai baht shot up to 40, 50 baht to $1, tremendous devaluation. So that's the kind of thing we watch very carefully.
Mervyn, if you could also expand on this from the Fitch perspective, how investors can anticipate, how they can monitor, how they can be mindful, because again, this has been such a frustration for emerging frontier market investors. They pick these great companies and only to be whacked with a currency devaluation and not delivering good USD returns to their investors.
I'll put back my ex-sovereign credit analyst hat on and absolutely agree with Mark. He mentioned FX reserves, external debt, and those sort of variables. I think sometimes when you look into the detail, there's a few other things that become quite apparent that's important. So what is the currency composition of that external debt? Do they have mainly local currency external debt, or is it foreign currency local debt? Because you get this potential doom loop when you start devaluating and then your actual debt profile to debt to GDP ratio actually rises when that devaluation happens. So you have to consider that particular aspect. I think with the on the African consideration, I think one recent development we have seen is Chinese lending and Chinese involvement into Africa, as well as a lot of other emerging market economies. And so in terms of the current account balance, there's always the opposite end, which is the capital balance. And how have these economies been funding a current account deficit for so long? Sometimes that capital investment coming in is quite stable, and sometimes it's not, and maybe has more geopolitical ties, for example, like the Chinese state loans. So there has to be quite a bit of consideration of if it's hot money that's coming in to finance, that's been financing the external finance position, or is it actually more stable money? So I think, I think those are some of the factors that you need to watch out for, and then it becomes quite contextual to the specific economy that you're looking at.
Well, thank you both so much for the session. It has been incredibly interesting and enlightening. Mark, Mervyn, your contributions and your input to AIM Summit and to our community has been invaluable. We discussed so many issues. We covered how your strategy in emerging markets at Mobius Capital Partners has been to take this friendly activist approach to help companies improve their governance, and how that has resulted in those companies having better financial performance and investors getting better returns. We discussed how the difficulties and some of the challenges, both culturally and in dealing with emerging markets companies, which are different from companies in a lot of Western markets where ESG criteria may be different, but you also highlighted that you hold companies in these emerging frontier markets up to the same standards. They need to hold themselves up to a certain level of ESG criteria in order to attract investment. We also discussed some of the disadvantages for companies in pre-industrialized countries that may need to develop and have not had the benefit of going through the development cycle that many other countries have. We covered so many issues. We had great questions from the Q&A. I'm so sorry, we still have 17 open questions that I was unable to address. We will try to follow up with those. I cannot thank you both enough for this amazing session. It's always great to have you. And to our audience, I'd like to tell you about our next session coming up on Monday, the 26th of October at 5 p.m. It's going to be all about trading around the US election. It's going to be hosted by none other than Anthony Scaramucci, the Mooch as he's often called. This is going to be sponsored by Equity Group. And we're really excited to be hosting that session. This election is probably the most important election in terms of the impact on financial markets and the economy of any recent US election that we've seen. So please join for that session. If you're joining us on YouTube, please like this video and subscribe to our YouTube channel now. Please also subscribe to the live session so you can be part of the Q&A and you can interact directly with our speakers and ourselves. Again, thank you so much, Mark. Thank you, Mervyn. Such a pleasure to have you today, and looking forward to seeing you again soon.